Bismillah.
Do you hear me? Do you hear me clearer than before or same?
I think it's the same. Can you hear me
Oh,
also?
all right. Yes, yes, I do.
Awesome, awesome. So let's go through this. So a little bit background before I hop into the simulator. So, I've been trying to get into, buying house for myself and my family for a long time. Back in 2014, around that time.
Mhm.
And because I just newly got married and I also had kids. In New York, it was very tough for me to rent a home with kids because a lot of landlords they don't like having kids knocking on the wall and things like that. So fast forward in 2021, Alhamdulillah, Allah gave me tawfiq to buy my first house with cash, and that solved the problem for me. But I know so many brothers and friends of mine are still in the conventional loans with interest riba. So that's why this is the only reason why I never got into conventional loans because of riba. Because Allah subhanahu wa ta'ala said in Surah Baqarah that whoever takes it's from riba, he's declare war with Allah and His Messenger. So this is the reason why I never got into it. But Alhamdulillah, now that this burden was lifted from my shoulder of having a house with riba, uh, I have, Alhamdulillah, Allah has given me tawfiq to work on something that I always wanted to do, Islamic financing. So, the existing Islamic finances that are available in the US, like four or five four or five mainstream ones. Among them, two or three of them are most popular. I'm not gonna mention the names here. Most of the people didn't know about them already. So one of them, I think two of them, they use this model called Musharaka al-Mustanaqisah, meaning shared partnership and lease at the same time. So if you're familiar with this model, uh, basically someone comes in, they choose a house. For example, here we are using a home that cost $300,000 with a 20% down payment, and that becomes 2000, sorry, $240,000 in the loan amount. And let's say he decided to pay that off in 20 years. You can also change it here. And with the conventional loans, most people go with Wells Fargo, as you mentioned. They currently has, I think, is 6.9%. Is that correct?
I mean, it changes over time, but that might be the average right now.
Okay. So with that much interest, and I think that's pretty much it for conventional loans. That with that much interest, you'll be paying in average $1,846 per month without the insurance and what other costs associated with it. Just 1,846 for principal and interest. Now, if you look into Musharaka al-Mutanaqisah, which is partnership, so same way, the buyer comes in and choose the house with $300,000, puts down 20% down payment. So he becomes 20% owner of that house. And the contract is to pay the rest of the amount, which is 240,000 in installments, in equal installments in 20 years. But on top of that, since he is only the owner of 20%, on the remaining 80%, he starts paying uh, rent, right? So the fair market rent for a house that costs $300,000 is about 2,100. So
Hmm.
whatever the 80% of that is, he pays the rent. That makes sense?
Okay.
So now, if you look at it and compare these two, so with conventional loan and halal financing, you'll see he pays a little bit extra. So he pays a little bit extra. So this is not the rent though. This is the combination of the rent and the buyout. So the buyout happens every month on an equal amount. So he chose to pay $1,000 every month along with his portion of the rent. If I go down, you'll see the breakdown. So for here you see he pays $2,680 total. So this is with halal financing, with Musharaka. So with Musharaka, he has the 20% ownership, and on the remaining 80%, he pays 1,680 based on the fair market rent of 2,100. So he
Hmm.
pays the rent on the 80%, which is $1,680. Make sense so far?
Okay.
And on top of that, he decided to pay an additional $1,000 to buy more share on the property, right?
So
So
the
this two
1680 goes towards the rent,
was
which doesn't be deducted from the house value or the
no,
remaining balance,
no,
but the 1000 per dollar will be.
exactly, yes.
Okay.
That's why
All
you
right.
see the starting balance, which he has to pay over time, is $240,000. So if you deduct that buyout, it becomes the ending balance becomes
Got you.
239,000, which
Okay.
goes to the next line as a starting balance. So this is
Okay.
how he's buying more shares on the property uh, and becoming a partner. And slowly, if you go over time, his share grows and it goes to 100%. And then you have no more balance remaining anymore. And also, if you look closely, look at this rent
Oh,
column.
I see that the rent
Yeah,
goes down.
yeah.
The rent drops.
Yes, the rent drops because he's buying more share. So the investor's share
I
drops.
like that part.
Yes, everyone likes it because no one wants to pay rent.
I like it because it's fair. No, it
It
is
is
fair. It is fair because you have more share. Why would you pay the same rent if you have less share?
exactly.
Or
Ex-
sorry, the other way around. Yeah.
Exactly. So the concept here is that so what people do right now to avoid riba. So there are two options. Either you go with the sorry, there are actually three options: conventional loan, which most scholars they don't allow except for the Rura, and also you should be careful with that. Even with conventional, even with the Islamic loan, you should be careful because not every Islamic loan is 100% Sharia compliant. So even with that, with Islamic loan, which is not 100% Sharia compliant, scholars give some, give some advice to stay on the safe side. So either way, what I'm trying to do here is to come up with 100% compliant, Sharia compliant,
Hmm.
halal financing, which is fair for both parties, right? And which does not involve riba interest at all. Instead, what we are doing is paying 8.4% annual rental rate. So annual rental rate is 8.4% if you use calc. How much is
Got
it?
you. Okay, okay. So the rent is a percentage and also the interest. Sorry. Yeah. Okay. So instead of doing interest, it's gonna be like an annual rent.
Yeah, so it's if you divide 8.4% by 12, that will give you 0.7% monthly rental rate, which is the market average right now. So we are using that to apply this 2100 to derive this 2100 from this 300,000.
Okay.
Okay. So if you just multiply 300,000 with 0. sorry, 0.7%, that becomes 2,100. Now let's come to the next part, which is the year-on-year appreciation, because the home value goes up, right? So home value, with the current, not the current rate, for the rate for like past 40, 50 years is been, if you predict the future, it becomes around this much. So we have three options here to choose from. Conservative, meaning that you're being very skeptical, the market is not going to be very good. It will just stay on the lower end of the appreciation. We'll get rent appreciation of 4%, and same with the home. So we have three options. Balanced is in the middle, and optimistic if you have a better luck. So with that balanced approach with 4%, this is what most people have on their lease agreement, that the rent will increase a certain amount of percentage every year, right? So
Hmm.
if you look closely here, so the rent goes down from 1680 to 1603, right? And if you go to next year, it it raises a little bit. See, from
Hmm.
1603 to 1660 because we applied that 4% rent appreciation. Now, with the home value appreciation, we are not doing that. This is only for a reference so that we understand like how much the house is going to be valued at in after 20 years. So after 20 years, the with this 4.5% rate, the house becomes from 300,000 to 723,000 in 20 years.
Okay.
And with that, you have a solid portion of 423,000 dollar value in your pocket. So basically, you are winning because at the end of the day, with even conventional loan, same as with halal financing, um, uh, you are only paying 200 or 260, around $62,000 extra, but you are gaining in appreciation, which is 423,000. So you're still gaining at the end in both ways. The question is, you are gaining a little bit less with conventional loan, right? Sorry, you're gaining a little bit less with the halal financing. So when you sell the house, you get around for 59, $60,000 extra if you go with conventional loan, but you're not losing money. You're just gaining less. Make sense?
Yes.
But you're losing your spiritual, your akhirah benefit. So to avoid that, this is the whole purpose of this simulator, to see like what are we gaining, what are we losing. Now, we have not factored in the insurance, the property tax with this, not for conventional, not for halal financing. So that's something we also need to consider. So if we factor that in, we will lose 3% of the investors' profit. So the investors will then get maybe 5%, around 5 or 5.4%, if we factor in the 3% for property tax and for insurance. Now, this model will generate around 4% to my calculation, around 4% profit. Because what you see here is annual profit rate, but also remember the amount of money invested from the investor side will be withdrawn every month, right? So they will get 1,000 every month back. So their profit, their ROI will also drop a little bit. So to my calculation, it was around 4%. Now, if you factor in because what the Sharia compliant guidelines, they say that you have to divide the insurance payments and the property tax payments between the investors and the homeowner to be fair 100%, right? So if the because with the conventional loan you don't do that. With the conventional loan, the homeowner is the only one paying the full portion of the insurance and the full portion of the property tax. On top of that, you have HOA and the other maintenance costs, if you need some repairing to be done on the house. So, but with the halal financing option, since this is a partnership, the costs are divided proportionally based on the share percentage.
Gotcha.
Right? So if we factor that in, the property tax, insurance, and also additional maintenance, it will go, around less than 4%. It will go even like 3%, below 3%. So
So
that's
you
my,
would add another a block over here to simulate the same thing, like the insurance and all of that.
yes, yes, yes.
Okay.
So if
And it would
you
also like a migrate or go up and down based on the shareholder.
yes,
Okay.
yes. So what's happening here is that if you divide this, so what the bank is profiting, bank meaning the Islamic bank here, they're profiting 262,000. 666. I'm just running this through my calculator app to see how much actually they are gaining in 20 years. So their investment amount is 240,000. So 200, yeah, 240,000. If you divide 262 divide by 240, that becomes around 1.09%. Let's say 1.1%. So uh, 110%. So that becomes 110%. But if you divide 110 divided by 20, that gives you 5.5% ROI, right? So this is only rand here. But if you run it through 20 years, it gives you 5.5%. Did you get the math? So divide this with the total investment, you'll get the ROI for 20 years. Then divide that with 20, you'll get ROI for 1 year, which is going to be 5.5%. Now, if you take the 2.5 or 3% out from the 5%, it becomes 2.5 or 3%, less than 3% for the investors. With that low, that's my main concern with this low percentage. I'm very skeptical that any investors will be interested in investing this model. We are already, like from the consumer perspective, you see this, they're paying only how much for the whole house? To 500,000, around 500,000, but they're spending 60,000 extra with the halal
Right.
financing. That is the main drawback, I would say, from the consumer's perspective. Because with this halal model, you have to you have to pay a premium, and that's the price, around 60,000. But if you look down here, like they're actually gaining at the end of the day, right? So to if we raise this up a bit just to give a little bit padding for our investors, let's say if we raise it up by 10%, then it goes even higher. So the total cost becomes 600. So they're paying around 100,000 extra, right? So that's my main concern, that if you have to make this model very feasible and profitable for both parties, they will initially see this amount. Oh, by the way, it might not be this bad because with conventional loan, you are also paying the insurance, which we are not factoring in here. So I would say, yeah, I would say 8.4% is fair, because if you factor the insurance and the property tax, you'll be doing that for both, right? For conventional and halal financing. So I think it's not that bad. What do you think?
No, I see the concept itself is very is very fair, and it serves both sides. Like the buyer who's looking for a house away from this conventional and not halal system with interest and riba,
Right,
and also is helping anyone who's trying to invest and make like some extra money on the long run.
right.
Like there are some other stuff that came to my mind, but I was just like waiting for you to finish. Uh, just like with conventional loans or mortgages, usually if you don't pay for a month, they send you a warning, and if you don't pay for the second, it's like a harsh warning, and for the
Mm-hmm.
third, they take the house out of from you. With the
Right,
halal, other institutes that I don't want to mention names here, but everyone knows them,
right.
they usually don't do that, right? And they try to work it out with you, but eventually, if you're unable to pay for a very long time, you end up with the same thing. But with the conventional mortgages, you lose your equity if you just like foreclose the house or couldn't pay
I-
for it. With the halal
I-
institutes out there, you don't lose your equity, but
Is
they
that
get to
so?
take
Like
it.
I have never been through this traditional model of home financing with the conventional loan. Is that what they do?
Yeah, yeah.
Let's say for
I'm
example, let's
aware of
simulate
that. That's
this.
what I'm trying to say. Yeah,
So if you after 10 years, right? After 10 years, you paid up almost like 50% of your house.
you lose all of
And
them.
oh, really?
Yeah.
Wow.
With
Subhanallah.
the convention, unless you do something called fast sale and you're able to do it in a very short time. A lot of people do it and they lose a lot of money.
Oh.
Like a lot of hunters are waiting for
Is,
situation like that.
is that called a pre foreclosure or something like that? That happens.
Pre-foreclosure is it might be a little bit different, but the fast sale or the bank fast sale stuff like that is when you get a little bit of your equity, not even all of it, right? A little bit.
Oh.
So you have two situations. If you're unable to sell it very fast, the bank will take it, they will claim it, you lost everything, you're
Oh,
outside,
wow. So
right?
basically what we are seeing here, you with the halal financing, you start from 20% and gradually get 100% ownership. But with the conventional loan, what they advertise at, you become 100% ownership. You become the 100% owner from the start. That is actually a gimmick. That's not true.
That's never true, yes. And
Wow.
but with the halal one, of course, there should be like some conditions in the
Right.
contract here that you have up to this amount of month. We cover
Yeah.
you until you get back on your feet, but it should be also conditioned
Right.
in a
Right.
way that both because this one is yes, like helping and a charity and everything. But also there are other people who are investing their hard work of money there and they don't
I,
want to
I,
like Muslim to Muslim is like bunyanul marsus as Prophet Muhammad
exactly.
said we're helping each other, we're tying up each other, but also like we gotta be realistic and not oppress each other.
Definitely, man. Definitely. I'm a little bit shocked to hear that because I never knew this. This is what they do. Like after like paying off your home for like 10 years, they can
Yeah,
take your home and lose all the equity.
yeah.
That's crazy, man.
It
That's
depends
crazy.
how harsh your situation is, because if you're like not really 100% struggling, it's better than someone who's just like not having anything to pay for a couple of months or something like that. It depends. Everyone has a
So,
situation, but the worst one is not to pay at all for like a couple of months. They
I
start
mean
to take
let's
action later.
simulate this. Let's say you paid off to 10 years and then with the halal financing we don't show the balance here. So the balance is how much here? Like after 10 years is like 120,000. So you have only 120,000 payments, that which is more than the principal. So you already paid up how much? 20. So just you basically paid up the 50% of it. What's
Mhm.
gonna happen if you cannot pay up after this point of time? 122,
Yeah, this is
128,000.
what I'm trying to say. Like there should be some rules and agreements between the buyer and the investors, the sellers, the company,
Mhm,
to say, hey, at any point, if you're unable to pay, we have to, of course, lawyers have to write this down.
mhm,
We can like give you until X amount of months to get back on your feet, showing your struggles. It has to be shown and agreed by the company, accepted. And the break should not have any interest or any stuff like that, because it has to also be done the halal way. So this is something I'm sure we cannot like decide on. It has to be like brainstormed, asked like some legal people
Right. I
about, but
have
it just
seen
came to my
I have
mind.
actually seen some of the examples what they do. They give a few months time, and within few months, if they cannot get back on their feet, what is the worst thing that could happen? The worst thing that could
Someone can
happen,
step in and buy it, for example. I'm not
well,
sure if you were asking me a question or saying
even
something.
before that, even before that, what's the worst thing that could happen is that since they already paid up 50%, they could lose like 1 or 2% for just for paying off the rent. So since maybe like for let's say for 3 months they could not pay around $3,600. So
Hmm.
the worst thing that could happen, they might lose, a couple percentage from their equity. That's the worst thing that could happen.
Right.
But since the investors are also losing because they are not getting the rent as a profit for that month, we could set up some time frame that if you cannot pay for, let's say, 3 or 4 or 6 months, then you might consider selling the all of your share, or might
Yeah,
want to
you get your
whether
money back minus this percent that you lost
right.
for whatever paperwork. Like because if you're gonna sell the property or do anything else, get another investor, get another buyer to step in. All of this
Mm,
is paperwork and management work. So they have to lose something very small for exiting for early exit.
right.
So there will be more scenarios. I'm sure it wouldn't be like 100% agreed on our quick call over here, but there
Yeah.
are so many scenarios and stuff to think about in this. But this is something came to my mind. I wanted to ask you about and you know
Awesome. Awesome.
yeah.
Awesome, man.
Another thing over here, we're in this call we're talking about both buyers and investors, right? I can ask any
Yes.
questions from both sides, right?
Yeah. Yeah. Definitely. Go
Yeah.
ahead.
So, of course, this is a great investment opportunity. Like for example, it can be any amount of people, and since this one is a house by house cases, you can get 10 people to invest in one property and 10 other people to invest in another property, right? There
Yes.
has to be a back end system to manage all of these investment separately and
Yes.
like
Yes.
something like that.
Per property basis.
Exactly, yes, per property.
Yes.
Like like you can find, for example, myself or anyone. Like, let's not talk about myself and yourself because
Yes.
we're different stories. But anyone, like a friend of mine who wanted to invest
Right.
in this property, and he also wanted to invest in another property. We cannot cross both of them because he might have nine other people in this property, but
Right.
nine different people in
So
that property.
that's
So.
what some of the investment firms they do. They dilute. So they dilute. They have one bucket
Mhm.
for like let's say 10 properties.
Right.
Everyone pours into one bucket. So they dilute the share proportionally and give everyone an average on average a profit or rent from that same bucket.
Yeah.
So,
And
but
also
that's
the
not what I was planning to do. This should be even more fair if we maintain separate buckets for separate properties. This way,
that's for
yeah.
sure. Because let's say I do have more investment to invest. I'm gonna make percentage out of this house, but my percentage will be different from the other house, but I want to expand my investments across multiple houses.
Yes.
I cannot be equal to someone who's investing in only one house. It has to
Yeah.
be fair in a way or another, but I'm glad we're on the same page on this one.
Yes. Yes.
So this is one thing that also came in my mind. And also like the percentage of a revenue or the net income or the profit of each property should be clear to all investors. So the way I saw it before, because I've seen many brothers are doing this example, but of course in a different way, in a house flipping,
Mhm.
they first announce that hey, we're about to hunt this house. Who's ready to invest? and
Mhm.
they open the investment opportunity for almost a month,
Right.
right?
Right.
So let's say 20 people wanted to do that. After this 1 month is done, that's it. They close it on 20 people. So we distribute the investment amount by 20 people, and each one takes share, right? Of
Right.
course, in the very beginning, we cannot do that because you don't have any upfront money investment. You first do it the other way around. I'm not sure if what I'm saying is making sense or not.
Well, it makes sense because that's a federal regulation. So if you raise fund from people in the US, you have to declare it as a security. So you have to register this. Every property it needs to be registered under the Security Commission
Yeah,
as a regulation D,
yeah.
Reg D.
Yeah,
So
but in the
that's what.
beginning, you're unable to do that because you don't have because if you're a well-established company in the future, yes, if you
Well,
have capital, you can go get the property and then collect your money back from the investors. But in the beginning, you don't have that money to invest upfront. So what you're gonna do, you're gonna do the opposite. You first gather the first 10 investors are gonna be like your magical starting,
mm,
right? You gather, for example, 10, 20, 30, whatever,
right.
who's interested people. Hey, how much do you have? How much do you have? How much do you have? Let's say
Mhm.
you gathered $20,000. Now you go and buy a property and then find a renter and do
Yeah.
the process reversed until you have like two like very solid standing on like some capital, and then you start to do the process the right way of
Right.
buying, then finding investors.
Right. Yes, that's how I was actually originally thinking of doing it
Yeah.
because we cannot reach out to, we can advertise it to masses um, to invest because that requires them to be accredited investors, which at the beginning we are not planning to do.
Yeah.
This is basically a friends and family kind of model that we will start small and then slowly scale it. So that's the
And I
plan.
also have another question, I'm sorry,
Yeah, go ahead.
about like the different amount of investments. Like let's say someone invested $10,000 and another one said, hey, I only have five or $15,000. I'm not sure if you want to set a minimum or not, but in my personal opinion, if we have a good, robust system of extracting your percentage based on your investment,
No,
I don't
definitely.
think we should have any minimum. But of course,
Yes,
the minimum should be like 5K at least. Like
I mean,
you're
the
not gonna
minimum
get $100.
helps. The minimum helps to, get the commitment from people. Yeah, you don't want people to invest like a couple $100.
Yeah,
That don't
exactly.
make
So the
sense.
minimum could be like, for example, $5,000. I know it's very little, but at least you can get people. It's like, hey, oh, only $5,000. You can find 100 people who can invest $5,000 rather than two people who can invest $20,000. You get
I
my
mean,
point?
yeah, it depends on the property value. There are some properties which are very low to start with. There are $100,000 properties also in some places. Um, yeah, these are the options that we have to explore basically.
Yeah. So
So.
what I was saying, like my question is, if someone invested $5,000, he should know how much he would get based on the 5,000.
No, definitely he should know.
And
Yes, that,
someone
that,
else
that
who
that's
invested 50,000, because I know someone who wanted to invest 50,000, for example. And I know another one personally who wanted to invest only 5 or 10,000. So each one of them should know exactly how much they can get
they should
ROI.
know. They should know because
Yeah.
what they are
Monthly.
gonna get back every month is the this percentage of
Yeah.
rent. Well, this percentage is not directly gonna go to them because there will be manager who will be managing the property. So the corporation or the LLC who's gonna manage it will
Mhm.
take around like, let's say 2%, and the remaining like 6.4% will go towards the investors, right?
Yeah,
So
yeah.
let's
So
say
if there's like
20%. Let's say
something to
20%.
yeah, if there's something to simulate this process on like estimated number, like we can say, oh hey, if we have a property that worth $300,000, like this one right here in the example, and we also add the other block of the property insurance and all of that stuff that we discussed earlier, we plug in the numbers, and let's say someone wanted to invest in this property with $5,000, he will make this much money on average every month.
Brother
If we
Ahmed,
can,
that's exactly I was planning to do the next. So this simulator is an overall simulator. The
yeah,
next one is going to be an app that user can download from the App Store and then see
Awesome.
how much they're gonna get.
Yep,
So
yep,
yeah,
yeah, yeah.
that's the
That's
next step.
some
So alhamdulillah,
brainstorming
another
right there, man.
point before I think we have like a couple of minutes left.
Hmm.
So before we go, there are a few questions that I got from many homeowners who go
Hmm.
with conventional loan. Is that some of them they bring this question about, oh, there are government regulations that you have to have a relationship with the bank, get the money from the banks, like or the this investment firms called Freddie Mac, which is connected with some of the Islamic finance
Hmm.
organizations too.
Yep.
Uh, but that's not in our case though, because we are not planning to scale at that level.
No,
So
no, no.
we are happy with two, three houses if that's big. Um,
100%.
the investment, the amount, the capital is only gonna come from halal sources, not
Yes.
from any banks or any ribawi organizations.
Hmm.
So that's something to get clarification. So another thing is that they mentioned that, oh yeah, we live in America, so we have to go by with their laws and regulations. Definitely, we should go with their laws and regulations. That's why I mentioned about the Regulation D, Rule 504 or 506, uh, because when you are raising money from people, people can fraud easily. You know, they can take the money and do whatever they want. But
Right.
these regulations with the Security Commission, they prevent the whoever managing the fund. They prevent them, uh, misusing these funds. So based on those regulations, so those are the regulations. But those regulations don't force us to get into riba because we live in America. That doesn't make sense. Just wanted to clarify that. So,
Uh, yeah, man.
all right, brothers. Thank you so much for jumping into this call and share your thoughts and asking the questions.
Thank you,
Jazakumullah
man.
khair, and I hope this will help so many Muslims living in the West, inshallah.
وإياكم brother, وإياكم. Thank you so much.
My brother,
All
take
right,
care.
bro.
Assalamu alaikum.
عليكم السلام ورحمة الله.